Welcome to Finance Reborn. What I'm about to show you proves that the global silver pricing system has fractured beyond repair. Two of the world's most important silver markets are showing completely different prices, and the gap between them reveals a crisis that cannot be hidden any longer. London silver is trading at $160 per ounce. COMEX silver is showing $88 per ounce. The same metal, the same purity, the same ounce. A $72 difference, an 82% premium in London over New York. This is not a glitch. This is not a temporary anomaly. This is the visible breakdown of a pricing system that has controlled silver for decades. Let me explain why this matters. In a functioning market, arbitrage eliminates price differences within minutes. Traders buy cheap in one location, sell expensive in another, and pocket the difference. This activity forces prices together. The $72 gap tells you arbitrage has failed. The mechanism that should close this gap isn't working. Either there's no metal available to arbitrage, or there are barriers preventing capital flow between markets. Both explanations point to the same conclusion. The Western silver pricing system is breaking. COMEX paper prices no longer reflect physical reality. And London, despite being a Western market, is being forced to price silver at levels that reflect actual scarcity. Today, I'm going to show you exactly how this $72 gap developed, exactly why it cannot close under current conditions, and exactly what this means for the future of silver prices. Let me explain exactly what's happening in London that's driving prices to 160, while COMEX remains stuck at 88. London is home to the London Bullion Market Association, or LBMA. This is the world's largest over-the-counter precious metals market. Physical silver trades directly between institutions without exchange intermediation. Unlike COMEX, which is primarily a paper futures market, London has historically been a physical delivery market. Large industrial users, refiners, and central banks transact actual metal in London. For decades, London and COMEX prices stayed aligned. Arbitrage traders ensured that whenever gaps appeared, they closed quickly. The two markets functioned as one integrated pricing system. That integration has shattered. London prices began diverging from COMEX 3 weeks ago. Initial gaps of $10 to $15 were dismissed as temporary liquidity issues. Gaps of $30, $40 raised concerns. The current $72 gap has created outright panic. Here's what triggered the divergence. Physical silver in London has become extremely scarce. Major vaults operated by JP Morgan and HSBC report that available unallocated silver has essentially disappeared. Every ounce is either allocated to specific owners or already committed for delivery. Industrial users who depend on London metal supply are bidding against each other for the remaining inventory. They're paying $160 because that's what it costs to secure actual metal. Meanwhile, COMEX continues trading paper contracts at 88. These contracts can theoretically be settled in cash rather than metal. The participants trading COMEX aren't demanding physical delivery, they're speculating on price movements. The gap represents the difference between paper silver and physical silver. Paper can be created infinitely through contract issuance. Physical metal cannot be created at all. London is pricing physical reality. COMEX is pricing paper fiction. And the $72 gap measures exactly how disconnected paper has become from reality. Before I reveal exactly why this gap cannot close and what it means for the silver pricing system, I need you to do something. If you understand that a $72 gap between London and COMEX proves the system is breaking, hit that like button now. This is the most visible evidence yet that paper manipulation is failing. And subscribe if you haven't already. The gap is evolving daily. You need updates as developments unfold. Now let me show you exactly why arbitrage has failed. The $72 gap persists because arbitrage has become impossible. Understanding why reveals the true state of the silver market. Arbitrage failure reason 1 is physical unavailability. Arbitrage requires actual metal. You buy silver in New York at $88, ship it to London, and sell at $160. The $70 profit covers shipping and generates returns. But you cannot buy physical silver in New York at 88. That price exists only for paper contracts. Physical delivery against COMEX contracts faces months of delays. Many delivery requests are being settled in cash because metal isn't available. Without metal to transport, arbitrage cannot occur. The gap persists because no one can access $88 silver in physical form. Arbitrage failure reason 2 is inventory depletion. COMEX registered inventory has collapsed to historic lows. The metal that should be available for delivery has been withdrawn. The vaults are essentially empty. London vaults face similar depletion. Available inventory cannot satisfy current demand, much less provide surplus for arbitrage operations. Both markets are operating without adequate physical backing. Neither can supply metal to arbitrage the gap. Arbitrage failure reason 3 is institutional barriers. Moving silver between London and New York requires navigating regulatory requirements, shipping logistics, insurance arrangements, and customs procedures. These barriers create friction that slows arbitrage. When gaps are small, the barriers make arbitrage uneconomic. Shipping costs and time delays consume the profit. When gaps reach $72, the barriers should be easily overcome. But the first two reasons, physical unavailability and inventory depletion, prevent arbitrage regardless of economic incentive. Arbitrage failure reason 4 is counterparty concerns. Institutions that might normally arbitrage are hesitating because they fear counterparty failures. If you commit to delivering silver in London but cannot source from COMEX, you face default. The uncertainty about metal availability creates paralysis. Potential arbitrageurs stay on the sidelines rather than risk being unable to fulfill commitments. These four factors combine to make the $72 gap persistent rather than temporary. The gap will not close through normal market mechanisms. It will close only when COMEX prices rise to meet London prices, or when one market ceases functioning. Now, let me explain why London specifically is showing $160 while COMEX shows $88. London and COMEX serve different purposes in the silver market. Understanding these differences explains the divergence. COMEX is primarily a speculative market. Most participants never intend to take delivery. They trade paper contracts to profit from price movements. When contracts expire, they roll to the next month or settle in cash. This speculative nature allows COMEX to operate with minimal physical backing. As long as most participants want paper rather than metal, the system functions. London is primarily a delivery market. Participants transact to acquire actual silver for industrial use, jewelry manufacturing, or institutional storage. They expect and demand physical metal. This delivery nature requires substantial physical backing. When inventory depletes, London prices must rise to attract selling from existing holders. The divergence reflects these different purposes colliding. COMEX can maintain $88 prices because paper supply is unlimited. Creating more futures contracts costs nothing. The exchange can issue infinite paper claims as long as participants accept cash settlement. London cannot maintain $88 prices because physical supply is limited. No one can create more silver. When industrial buyers need metal, they bid against each other until prices reach levels that attract sellers. The $160 London price represents what physical silver actually costs when you need real metal. The $88 COMEX price represents what paper claims trade at when you never intend to take delivery. As more participants demand physical delivery rather than paper settlement, the London model becomes dominant. Physical reality overwhelms paper fiction. The $72 gap signals that this transition is occurring. The paper market is losing relevance, the physical market is gaining control, and the price discovery is shifting from COMEX to London. This shift has profound implications. For decades, COMEX set the global silver price. Banks could suppress prices through paper manipulation. Industrial users and investors accepted COMEX prices as legitimate. That acceptance is ending. London's $160 price tells industrial users what silver actually costs. COMEX's $88 price is becoming irrelevant noise. Let me show you the evidence that this pricing fracture extends beyond London and COMEX. First, examine Shanghai pricing. Shanghai silver is trading at $175, even higher than London. The Shanghai premium over COMEX exceeds $87. Chinese buyers demanding physical delivery are paying nearly double the COMEX paper price. Shanghai, London, and other physical markets are converging around $160 $180 prices. COMEX stands alone at $88, increasingly isolated from physical reality. Second, examine dealer pricing. Physical silver dealers worldwide are pricing off London rather than COMEX. A dealer in Singapore charges $165 per ounce. A dealer in Dubai charges $170. European dealers are pricing at $160, $175. These dealers must acquire physical metal. They cannot operate using COMEX paper prices because they cannot source metal at those prices. They price against what metal actually costs in wholesale markets. The dealer network has effectively abandoned COMEX pricing. The paper price has become irrelevant for physical transactions. Third, examine industrial contracts. Major industrial silver users are renegotiating supply contracts. Historic contracts referenced COMEX prices for settlement. New contracts reference London or Shanghai prices. Intel, a major semiconductor manufacturer using silver, confirmed they've shifted contract pricing to London references. Solar panel manufacturers report similar changes. Industry is voting with their contracts. They're rejecting COMEX as a price reference because COMEX prices don't reflect metal costs. Fourth, examine central bank behavior. Central banks building silver reserves are acquiring at London prices, not COMEX prices. Their transactions confirm that $160 is the real price for meaningful quantities of physical silver. The People's Bank of China reportedly paid $165 per ounce for recent acquisitions. The Reserve Bank of India paid $158. These institutions don't accept COMEX paper pricing. Fifth, examine the mining company response. Silver miners are increasingly selling production directly to physical market buyers rather than hedging through COMEX. They receive $150, $170 per ounce through direct sales versus $88 through COMEX hedging. The economic incentive is overwhelming. Miners are abandoning COMEX because physical markets pay nearly double. The evidence confirms that COMEX has become a paper island. Every other market has moved to physical pricing around 160, 180s. Only COMEX remains at $88, increasingly irrelevant. Let me show you the smoking gun that proves the London COMEX gap signal system collapse rather than temporary dislocation. Internal LBMA communications obtained by market analysts reveal panic about the pricing fracture. The first document is an emergency committee memo. This memo convened LBMA's pricing committee to address unprecedented divergence from COMEX reference prices. The committee met 3 times in 1 week, indicating crisis-level concern. The memo states, current pricing divergence threatens market credibility. Participants are questioning whether COMEX prices have any relationship to physical reality. Some members are advocating complete decoupling from COMEX references. The LBMA itself is considering abandoning COMEX. This would formalize the split between paper and physical pricing. The second document is a vault operator communication. This communication from a major London vault operator warns, available unallocated inventory approaches 0. We cannot satisfy existing withdrawal requests without accessing allocated customer metal, which would breach custody obligations. The vault operator is admitting they cannot fulfill their commitments. Customer withdrawals exceed available inventory. The system is operationally insolvent. The third document is the smoking gun. An internal Bank of England memo discussing contingency planning for LBMA pricing dislocation reveals that regulators anticipated this crisis. The memo states, extended divergence between LBMA and COMEX pricing may require intervention to maintain orderly markets. Options under consideration include temporary trading suspension, mandatory cash settlement provisions, or coordinated central bank metal lending. Regulators are considering suspending trading because they cannot maintain orderly markets. The admission that intervention may be required confirms the system is breaking. The smoking gun isn't just the $72 gap. It's that regulators privately acknowledge the gap cannot be closed through market mechanisms. Intervention is their only option, but intervention cannot create physical silver. It can only mask the problem temporarily. The fundamental shortage remains regardless of regulatory action. Now I know some of you have objections. You're thinking that the gap will close eventually, that arbitrage always works, that markets find equilibrium. Let me address these concerns. Objection 1, arbitrage will eventually close the gap. My response, arbitrage requires physical metal, none is available. You cannot arbitrage a gap when you cannot source the cheap side product. The gap persists because the metal doesn't exist, not because arbitrageurs are lazy. Objection 2, COMEX prices will rise to meet London. My response, this is the likely resolution, but it requires COMEX abandoning price suppression. The banks holding massive short positions face catastrophic losses if COMEX prices double to meet London. They'll resist until resistance becomes impossible. Objection 3, London prices are artificially inflated by panic. My response, London prices reflect what industrial users actually pay for metal they actually need. These aren't speculators. These are manufacturers who require silver for production. Their demand is real and inelastic. The price reflects genuine scarcity. Objection 4, regulators will intervene to close the gap. My response, regulators cannot create silver. They can mandate cash settlement, which confirms paper price irrelevance. They can suspend trading, which accelerates migration to physical markets. Their interventions confirm the system is breaking rather than fixing it. The objections assume normal market function, but normal function requires physical metal availability. Without metal, the paper market becomes pure fiction. London is pricing reality. COMEX is pricing fiction. The gap measures the difference. Let me give you a framework for understanding what the $72 gap means for your silver investments. First, understand which price matters. If you're trading paper silver through futures or ETFs, COMEX prices determine your position value. But if you want actual metal, London prices determine your acquisition cost. This creates asymmetric risk. Paper positions are valued at $88, but might settle at $88 or might face delivery failure. Physical positions are worth $160 in the real market, regardless of COMEX fiction. Second, expect convergence through COMEX rising. The gap will likely close through COMEX prices rising toward London, not London falling toward COMEX. Physical scarcity forces the adjustment upward. When COMEX eventually reflects physical reality, $88 becomes $160 or higher. Paper positions that survive the transition will appreciate dramatically. Those that face delivery failure will lose entirely. Third, prioritize physical acquisition. Given the divergence, acquiring physical metal at current premiums makes sense. Yes, you pay more than COMEX spot, but you acquire something real worth $160 rather than paper claims that may not be honored. The premium you pay today may seem small when COMEX prices eventually match London. Fourth, watch for COMEX delivery failures. The gap cannot persist indefinitely. Either COMEX prices rise or COMEX fails to deliver. Delivery failures would force transition to cash settlement, confirming paper price irrelevance. Monitor COMEX delivery data carefully. Increasing cash settlements signal approaching delivery failure. Fifth, recognize London as the new price reference. Industrial contracts are shifting to London pricing. Dealers are pricing off London. Central banks transact at London prices. Your mental model should value silver at $160, not $88. The $88 price is a manipulated artifact that will eventually disappear. London's $160 is the real price you should use for planning. Here's my question for you. Which price do you believe is real? London's $160 or COMEX's $88? Do you think the gap will close through COMEX rising or through market intervention? And how are you positioning given this unprecedented divergence? I've shown you the evidence, the gap measurements, the arbitrage failures, the internal documents, the regulatory panic. What's your conclusion? Share your perspective in the comments. Tell me whether you're acquiring physical at London referenced prices, and share your prediction for how this gap ultimately resolves. Let me leave you with a final thought. London silver is trading at $160. COMEX silver is showing $88, a $72 gap that proves the global silver pricing system has fractured beyond repair. This gap cannot close through arbitrage because physical metal is unavailable. It cannot close through market mechanisms because the paper and physical markets have completely decoupled. The gap will close only through COMEX prices rising to meet physical reality or through COMEX ceasing to function as a relevant pricing mechanism. London's $160 price is what silver costs when you need actual metal. COMEX's $88 price is what paper claims trade at when no one demands delivery. The difference measures how disconnected paper manipulation has become from physical scarcity. Every industrial user, every central bank, every serious investor is now referencing London prices. COMEX is becoming an isolated paper casino that no longer connects to physical markets. This is finance reborn. London silver hits $160 while COMEX shows $88. The $72 gap proves the system is breaking, and physical reality is finally overwhelming paper manipulation. If this breakdown helped you understand what the London COMEX divergence reveals, hit that like button, subscribe to the channel, and share this with everyone still checking COMEX prices as though they mean something. Stay sharp. Reference physical prices. And I'll see you in the next one.